Introduce ourselves. We're the Arrington team from San Diego Funding. I'm Alexis Arrington, and this is Linnea Arrington. And this is our Mortgage Matters. And again, anytime if you have questions, comments, whatever, go ahead and put them in the chat, or raise your hand or come off mute and let us know. But we've got kind of a busy day. We got two major topics that we're going to be discussing, and those are interest rates in the bond market, and then the Fannie Mae condo guideline changes. These are two things that are really impacting our market today, and we could see impacting our buyers and sellers. Sorry.
Well, before we start, we just want to explain the reason that we're having this early, because, our Mortgage Matters is normally the first Tuesday of the month. And we were having it early because first Tuesday is after Labor Day. And we also didn't want to wait a month to give you this information because we just think it's too important.
Mm-hmm. Okay. Exactly. So with that, I guess we'll jump into our first topic, which is the bond market and interest rates. Interest rates are going to stay higher for longer. We've been hearing that a lot. But at the same time we've been hearing that, we've been seeing inflation data staying steady or even coming down. It came down in the past, stayed steady last month. So why are rates so high, and why'd they go up this month? Why are they staying so high?
So, last month the Fed said that they weren't going to be doing anything because they're not meeting this month, in the month of August. And they were just going to, when they met again next month in September, or I think it's October before they meet, that they're going to be analyzing the data and deciding what to do. So everybody's been, anxiously, when that data came out in August, everybody was, looking to see what was going to happen. And the data was it wasn't aggressively good, but it was very just kind of the status quo. Inflation didn't go up. It was the first month it didn't go down, but it didn't go up. It stayed steady. The CPI, Consumer Price Index, and the Producer Price Index were both steady as expected. So everything was as expected, and interest rates started the days those came out to improve, and then they quickly took a turn, and interest rates went up. And, I looked in the market to try to find out what was going on, and everybody said they couldn't figure out why this was happening. It shouldn't be happening. And even the next few days, everybody said this shouldn't be happening. But, when you look at what happened, so something really did happen that caused it. It doesn't just, things just don't happen without a reason. And so this is what happened. On July the 29th, on July 31st, it was announced by the Treasury, and they surprised everybody by this announcement, that the government was anticipating raising a net of $1.7 trillion through bond sales in the third quarter. That is the largest amount to raise during a third quarter in the history of sales. And it was also 25% more than was estimated just a few months earlier. That was a shock to the market. And I want to explain why that was such a shock to the market. Because mortgage rates are tied to the 10-year bond. And the reason they are is that mortgage rates, even though they're 30-year fixed rate loans, you would think they would be tied to the 30-year bond, but they're not, because in anticipation of how long a loan will stay on the books is an average of 10 years. So if they have a bond of 100 loans, that 100 loans is expected to have an average life of 10 years. Some will last longer, some shorter, but 10 years. And so it trades the mortgage-backed securities trade equivalent to the 10-year bond. So whenever we want to know what's happening to interest rates, we look at what's happening to the 10-year bond. And that really gives you a good indication if interest rates are going up or down. So after the Fed announced that they were going to be borrowing 25% more than anticipated, and 25% is a small amount if you're borrowing a small amount, but with the amount of our borrowing, it's a huge amount. Then the next day, or let's see, it was a few days later, yeah.
Okay.
That it was announced that our rating was downgraded from AAA to AA plus. And that again was because they said of our current, economic situation, that it was because of what was being borrowed just to substantiate, to pay for our debt, our new debt. And so that's really something that we have to keep in mind now, because it's not what it's doing how does that affect the Fed? It's affecting the Fed is because it's taking a lot of the Fed's work for them. In the past, whenever interest rates started to come down a little bit, the Fed would come out with some negative thing and they would say, oh, wait, we're not going to be reducing interest rates. We're still going to be raising them, because the Fed has not wanted interest rates to go down. So now the bond market, because of the debt that the government is having to borrow, is taking the place of a lot of the pressure that was put on the Fed. So the Fed can relax a little bit. They can not raise rates, or they can raise them, whatever they decide at the next meeting. And we're still not going to see interest rates go down right now until the bond sales really are finished, this majority. And this is from the last stimulus, really. And that stimulus is projected to go on for about another year.
But with the bonds, you have this great quote from Mark Lindblom, if you would like to read it.
Right. So what Mark said is when it came out of the amount of the sale that had to go on to sell bonds, he said, somebody's going to buy them. It will be done. But the question is, at what price? And that's what we saw. We saw what it cost to get it done, because we're having to attract so many buyers that we weren't anticipating attracting. And the way you attract buyers is to give them a higher yield. And a higher yield is a higher interest rate. Yes.
So then what about the second reason?
Well,
buying these bonds.
Did we talk about that? There are 4 reasons that we're going to talk about.
So there's 4 reasons that we're going to go over. The first one is kind of what's happening with the bond market. The second one is who buys our bonds. How about that?
Well, everybody across the world buy our bonds. Our bonds are bought by people in the United States, and mainly corporations and people that need a safe way to invest money for short term or long term. So if they don't want to put their money in the stock market, they go to the bond market because they don't want their money sitting there and not making money. And so when they buy bonds, they get a certain interest rate that's guaranteed for a certain length of time. And one other thing that I didn't mention when I was talking about mortgage-backed securities, the reason mortgage-backed securities, other than that they're both 10-year, relate to the 10-year bond, is that mortgage-backed securities are insured and guaranteed by the U.S. government, because they're Fannie Mae, Freddie Mac, FHA, and VA, all of which are either insured or guaranteed by the U.S. government, as our mortgage backs, as our bonds. So they're looked at very much the same as a bond, because they've got the US government backing them. So the second thing then was, who buys our bonds, as Alexis just said? Well, they're bought by corporations, but we also look to the world to buy our bonds. Several years ago, China was a big buyer of our bonds, and then Japan has been a big buyer of our bonds for a long time. And the reason Japan has been a big buyer of our bonds is because their interest rates have been 0 for a long time. They have had no inflation and 0% interest rates. So the Japanese were a large buyer of our bonds. But something else unexpected happened this month, and that is the Japanese declared that they are raising their interest rate. So when they raised their interest rate, that didn't take away all of our Japanese buyers of our bonds, but it took away some, because they're very nationalistic, and if the bonds are paying something, they want to support their government. So not only did we need more cash, so we had to sell more bonds, the United States, we lost Japan as one of our we didn't lose them, but they are not as strong of a major buyer. Yes.
All right. And then our third reason would be a boost in the U.S. economy. Can you talk a little bit about that?
Well, the U.S. economy has been a surprise to the Fed from the very beginning. So they expected the economy to react very strongly to the increase in interest rates. And every time they increased interest rates, they thought the economy would react to it, but it didn't. We have had a very strong economy. We continue to have a very strong economy, and it defies all the increase in interest rates. And you want me to talk about the 3 things? Okay.
Go for it.
There are 3 major things in the economy that the Fed didn't expect. One, the U.S. spending remains very strong. It's, all the people are spending money. Yep. So number 2, job growth is moderating, but is still very strong. And they expected that to decline. Mm-hmm. And the third thing is that hiring continues at a historically strong pace. And the nice thing about the hiring is that the increase in interest rates has moderated, but hiring is still very strong. So we have a very strong economy and a very strong job market. So the economy is something that has not reacted to the Fed the way they wanted it to react.
Which begs the question, how much further can inflation decline if the economy doesn't start to cool? And that leads us to point 4.
So the economists now, if you listen to the news, the economists are starting to change the way they talk about inflation. So the Fed, even the last time they talked, the Fed said, we are going to work on getting inflation down till we get back to our goal of 2%. 2% is what we're getting at. Well, you're starting to see the talking about that changing. And it's talking about more about 3% inflation and maybe 3.5% inflation. So higher interest rates for longer. Once again, backing up what the Fed is saying, if we can't get to 2%, and at the beginning of the year, when we were talking to buyers and we were talking to everybody, we were talking about, inflation coming down, interest rates coming down, everything happening this year, by the end of the year. Now that talk is completely different. When we're talking about interest rates higher for longer, the talk is still that interest rates will come down this year, but not hugely. They will moderately come down, that we maybe get to 6 3/4 by the end of the year, maybe 6 5/8, but higher for longer and into more like the mid next year before we get to low 6s and high 5s. So we're a year away from getting interest rates to where we thought they would be at the end of this year. So we're almost a year behind on what our anticipation was at the beginning of the year. And the interesting thing about all of that is the buyers know that. The buyers feel it. And so the main thing you have to do, because the buyers also want to know why interest rates went up. So we all have to be educated in that so we can explain it to them in a very simple way and just say that the government borrowing was higher, because there's two things about the borrowers doing in that. What the government is doing when they borrow money, they're borrowing the deficit. We have a deficit because we're still spending stimulus money. And that's going to go on for another year, the third stimulus bill. So we're still borrowing money, but we're also having to support our existing debt at a much more expensive rate because we're having to borrow that at these increased interest rates where that debt was all originated at a very low interest rate. So there's two reasons that the borrowing has gone up so fast.
But your buyers, we kind of know this. The buyers know this. They're not afraid of the higher interest rates. They want to be in this market. So what would you say to a buyer who might be hearing this and get a little nervous?
Well, a lot of buyers got nervous when we saw the interest rates go to 7 1/4. And what I see is that every time the interest rates go up, the borrowers pull back. And then when interest rates drop a little bit, which they're starting to do right now, so hopefully we'll see, that quarter drop in the next week. So as interest rates drop, then all the buyers come back in. And once they come in, they usually don't leave. And because we're closing a lot of loans this month. And, because they're locked in at that lower interest rate, but also we're having buyers writing offers today that came back in when they came down a month and a half ago. They came in and they didn't leave. So they're buying now, even at the increased rates, because they have figured out they qualify and they've got the payment in mind. Mm-hmm. We figure out a way to get their payment a little bit lower so they're comfortable with it. That's our job, is to figure out how they can qualify for what they want to buy, or get them to bring in more money to qualify. So I still see a very strong buyer's market. And that will continue because we don't have enough properties. And, everybody's blaming the fact that we don't have enough properties on the fact that people aren't listing because they've got low interest rates. We don't have enough properties because they haven't built enough homes. The whole year we built apartments. We built tons of apartments, but the number of homes that were built were very limited.
Condos.
And
or single family. Yeah.
Well, condos, I'll take condos, but we need more housing. In order to get the prices of housing down, we have to have more homes built for owner-occupied buyers.
Yep. All right. Well, and with that, we're going to move on to our second topic. Again, if anyone has any questions.
Oh, wait a minute. I didn't mention one thing.
Yes.
I didn't mention. So what do we do for the next 3 months to make, to get sellers to sell and buyers to buy? And one, the next drop we see, we're going to have to push really hard to get those buyers back, because this is going to be our really last, chance to get buyers in so that they're buying before the end of the year. But once again, sellers are getting top dollar for their homes, even in this market. And they've got to be priced right. We've got to get them, structured right, and watch for interest rates to come down a little bit and get those sellers back in, because we'll have another one last, I think, really good buyer's market and seller's market before the end of the year.
Perfect. All right. And now with that, we're going to move to our second topic, which is the Fannie Mae condo guideline changes. And so I just want to start this by asking, why are we seeing these changes? And then we'll go into what the changes are, but why?
Well, we haven't seen a big change in Fannie Mae guidelines and condos for a long time. And, I want to equate this to like a year ago when we saw their guidelines for second homes change. And the reason they changed second home, the way they look at them, and they look at them more like investment properties, because they looked at tax returns and they saw that most people that bought second homes ended up renting them most of the time. So they used them as second homes, and they were second homes, but they were also investment properties. And so they are now second homes for Fannie and Freddie are looked at like investment properties. So once again, so what happened with condos? And when we first heard they were changing the guidelines, we thought it was because of the condo that fell down in Florida, and because of the deferred maintenance on it, and that the HOA wasn't proactive in doing the work. And so we thought this is a reaction to that. We went to a meeting last week that Fannie Mae gave to explain their program and what they wanted from their lenders. And, that question was asked of Fannie Mae. They said, well, is this in reaction to the Florida property? And they said, no, this is a reaction to our questions to homeowners, to our clients, our mortgage holders, when they make late payments or are deficient on their payments. And we go to them and we ask them, why? What happened? Why are you late on your payments? Why are you defaulting on your loan? And their answer in the majority, and so many times when it was a condo purchase, was that they didn't anticipate the special assessment. They didn't anticipate the increase in the HOA fees. And they were, had budgeted the money to make the payment, but that made the payment more difficult for them to make. And so Fannie Mae and Freddie Mac, when they see a consistency in answers from their clientele, they figure out what can they do to change that. And that's what these new conditions are, in a reaction to buyers being unaware when they closed escrow of what they should anticipate in the future on their condo fees.
And so what are these new guidelines? Well, it's basically having a new form, a new system of finding out the answers to these two questions. The first, are there any current or planned special assessments? Do they see any coming up on the horizon? That kind of stuff. The second one is this, does the project have any critical repairs or deferred maintenance? Because those things could trigger a planned or current special assessment later on. So that's what they're now asking us to answer before we get into before the buyer closes on escrow. So the way they're doing this is through this form, which I'm going to actually send the link in the chat if anyone wants to click on it and read along with us. We're just going to highlight a few of them. So this is something that we'll be sending out on just our limited reviews.
So yes. This is an actual Freddie Mac form that Freddie Mac prepared. Fannie Mae's form was more elongated, but it really asks the same questions. So the form that we're going to be sending out is really the Freddie Mac form, which answers the Fannie Mae and Freddie Mac questions.
And so a few of the highlighted questions on here are on your screen. And it's like, when was the last building inspection? Did the last inspection have any findings related to safety or soundness of the building? If yes, have these repairs been done? Is the HOA aware of any issues? Because again, we're looking for the HOA putting in a special assessment. And then
because of deferred maintenance,
deferred maintenance, yeah. Are there any outstanding violations of jurisdictional requirements? So that's like zoning. Does the project have any funding for planned or deferred maintenance, or have a funding plan for deferred maintenance? Because that's, they're knowing that this is going to happen, and they're going to be talking about how they're going to fund it. Does the HOA? Oh, sorry.
Do they have the money to fund it? It's really what. Do they have the money to pay for those problems?
And then does the HOA have a reserve study completed in the last 3 years? They are required by California law to have a reserve study. And a reserve study, what that shows you is the economic life of all of the different parts. So for example, the economic life of the roof. It also is going to be asking about, or when they think the roof needs to be done and how much it costs. So that's kind of what a reserve study says. And then
it shows if there's adequate funds there at the time that it's going to be needed to do those repairs. So that really the review shows what is anticipated and what will be there. So if there's going to be a deficiency, then that's a sign that there may be a special assessment coming up.
Yes. And then lastly, are there any current special assessments the owners are obligated to pay? We think that this is the most important one on the entire sheet, although all of them are equally important, but it really tells you, will their fees be going up? And then before I move on, Ben McCoy put some questions in the chat that I want to read out, and then you can answer. What happens if the HOA management company doesn't respond to this or fails to complete it?
Well, the HOA companies must have noticed, because we have a condo that we're doing loan right now, and this form, we sent this form. It's a limited review, and we sent it, and they completed it without a question. They completed every single question and completed it correctly. What Fannie Mae and Freddie, we didn't talk to Freddie Mac. What Fannie Mae said in their meeting, if an HOA will not complete this form, then Fannie Mae will not guarantee and insure the loan. That's all they said. It's up to you. If they don't complete it, we do not want the loan. So these questions are not, voluntary. I mean, are required in order to do a Fannie Freddie loan.
All right, and then second, which loans will require this worksheet? So this is the Freddie Mac Fannie Mae worksheet. FHA has already implemented this a while ago. They have their own worksheet. So this is just on Fannie Mae backed loans.
Fannie and Freddie.
Right.
Well, FHA, once they approve a condo, they only take it off if they're notified that there's a deficiency in the condo. And VA, the same thing. So once a loan, because FHA reapproves their properties every 3 years. So once a loan is FHA approved, when FHA approves a condo project, they have their own questionnaire that they ask. And so they check this all out before they ever approve it. And that's why they want them to be reapproved every 3 years. VA only takes it off if they're notified by the appraiser or by someone else that there's a deficiency.
Yes. And then Mark McDonald asks, so the lender sends out this form. Yes, we send out this form, but there are documents that we will need to get for
a full
review. And as a listing agent, maybe you might want to ask your seller for if they have them. Just, if you want to be proactive with these changes. And that is the reserve study that we just talked about. Any HOA minutes that they've received, because in the HOA minutes, they'll discuss any of these deferred maintenance or special assessments, and then the budget. Do you want to talk?
Well, on a full review, so if we're doing a 95% condo loan, those are things that we do need. We need the budget, then we need the reserve study, and we need we've not asked for in the past for copies of the minutes, but Fannie and Freddie have said that those are things that we can get to show if there's going to be special assessments. So, but this form will also say that, and so we may not need the minutes. Perfect. But if you're wanting to know if a project is looks solid to begin with, really the budget and the reserve study are the two that really show a lot.
And your seller should have those, and they should be able to get them as well. And the HOA minutes also should be sent to your seller.
They're required to be.
They're required to be. It's whether your seller has them or not is the question, but they should be. So if you're looking to list a condo before the next HOA meeting, maybe you ask your seller to hold on to them, just to check. But those are things that you can do as an agent to be proactive. But yes, we send out this form as part of our package to the HOA.
But we don't get it back usually until like a week before closing. So it's, and the problem with that, and I wish there was a way to get this faster. The escrow doesn't send out their request for documents until the seller gives them the money. So if they could get the money sooner, then they would send it out sooner. It's just the buyer doesn't know 100% for sure that their project is going to be approved until we get this documentation. And if they've already done their property inspection and appraisal, sometimes they get very upset if the condo doesn't meet Fannie and Freddie guidelines. So just the more information we can get sooner is going to help all of us.
So Ben put another question. So as a buyer, do we have this worksheet be part of the loan contingency period?
Yes,
100%.
definitely.
100%.
Do not remove
Yes.
contingencies until you know the lender has signed off on the condo.
And you guys are asking really great questions because we actually put this Q&A together. And here's this exact question. My loan is approved contingent on the HOA certification form, but that isn't in yet. Can I remove contingencies? And we say a big no. You know, your buyer also should be reviewing the HOA docs, and this will come back with those documents, most likely. And so your buyer wants to review these. You don't want to just have your buyer go in blind because sorry.
The strange thing is I don't even think we give this to the buyer. This is really for us. So I think we should start giving this to the buyer so the buyer can see what questions Fannie Mae and Freddie Mac wanted answered and how the HOA answered them.
But and I was talking about the other HOA docs. You don't want to have your buyer remove contingencies before getting those docs. I mean,
looking at
from
the
a
budget.
loan standpoint, but also just, they're buying into this property. They should know what's going on with the HOA to begin with. And for example, I had a loan last month where we were ready to remove contingencies. We ordered our own HOA documents because the seller was not wanting to order them right away and was trying to get them for free, which I don't know if you guys have ever done that, but HOAs don't really give out documents for free. But so the seller was kind of dragging their feet. So we ordered our own and the buyer paid for it. But the agent still wanted the HOA docs from the seller before removing contingencies. And she used that to get the contingencies extended because the buyer's required to read off on those and sign off on those, or they're given the opportunity to do so. And removing contingencies before the buyer has that opportunity
is not wise.
It's just
it's really a big no.
And so if you have to extend contingencies, you can point out exactly the HOA docs. It has nothing to do with our loan, except for the fact that we need these docs to sign off on loan approval. But yeah, real quick. Yes, exactly. Mark said you can remove all contingencies except for the HOA docs, so the seller is more comfortable. Yep, definitely. And then Ben said, big question. If the condo project fails the test, is the loan/escrow dead?
Well, it depends on how much they're putting down. Portfolio loans, that a higher interest rate, often will do some of these. So you might be able to do this loan with a portfolio loan, but they're going to require more down payment. Really, the loans that are most, requiring Fannie and Freddie are ones that are having 5 or 10% down. And those, if we cannot get this form filled out that meets Fannie and Freddie guidelines, and if they say they're already for maintenance and it's health and safety, then it's a project that Fannie and Freddie probably do not want to lend in. And so if we can't certify that it meets their guidelines and their requirements, then we would not be able to do a Fannie or Freddie loan in that project.
Yes. So that's why, as a listing agent, maybe kind of getting an idea if there's any issues up front is good, because you don't want that deal to fall
through right before closing. Right.
So that's something you can do maybe as a listing agent if you are aware of any issues.
And all you have to do is send us a copy of the budget and the
reserve study.
And we'll look at it real quickly. It just takes, and we can tell you, how strong the HOA is. The HOA is supposed to be fully funded, and fully funding is putting aside 10% of the gross income. So if the gross income from all the units is $100,000 a year, then they should be putting away $10,000 a year towards in their budget for the reserves. So they should be putting $10,000 a year into the reserves. if the income is 100,000, so 10%. And when you look at that, if they're not doing that, then it shows that they're in the red, that they're behind. And that's why the reserve study, which happens every 30 years, and that really breaks it down if they're in arrears. And that's when you know that if something goes wrong and they have to put a new roof on or something, there will probably be a special assessment. And that's what your buyer wants to know.
Because we have this question on everybody's concerned about what the present HOA is. How do I know what it's going to be next year? You learn that from if
Right.
there's any special assessments that might come up. So the reserve study, if there's extra money in the budget, if something happens, that's the kind of stuff you're looking for as a buyer.
So having a low HOA when you're a buyer isn't always the best thing, because maybe there's maintenance there that's not the reserves that aren't being put away as they should be. So you do want to know that reserve study.
And that kind of brings us to time, but I don't know if we wanted to answer any of these other questions from the Q&A, but
well, we can stay on.
yeah.
So we can stay on. We'll just sit here and answer them. And if you want to stay on, you can, but we understand if you have time frames and you'd have to leave. So we'll just stay here and answer the questions.
Perfect.
Okay.
All right. If your buyer asks, how can we get the HOA docs faster? Kind of discussed about this a little bit already, but
and we talked about this at a meeting that we gave. We gave kind of a preliminary meeting in La Jolla this week just to try out some of these questions. And that was one that we talked about. And, you know, the most important thing is that, you know, we ordered this right away. So as soon as we open a loan, we order this. So we're getting these in. I think the last one we got in was a week. And I'd already done my appraisal though, because we had contingencies. So I've already done everything. But the way you get the full documents that the seller provides, so because we don't get those, they get them, is to get the seller to put their money in right away. In like a day or two, just like you want the buyer's money, you want the seller's money there so that the escrow will order the full escrow, the full document package, so your buyer will see that. If your buyer wants to see it before they order, because let's say it's a project that you're a little concerned about, you can see some deferred maintenance and you're concerned about it yourself, you might, as a buyer's agent, request that they pay, that the seller orders the HOA docs within 2 or 3 working days, just like you require the buyer to order the appraisal within a very short period of time. And then it's going to be the buyer's decision if they want to hold off on their property inspection until they have those HOA docs. But once again, that's a problem to do that. But you might get the budget and the reserve study, and then we can tell you, send them to us and we can tell you if they're strong or if it's weak, and to help you make that decision.
Let's see, we had a couple more questions. Ben, I'm going to come to your insurance question after Mark's question, which is the typical range of additional fees for this additional info for the HOA. So how much does this cost?
This form will cost as much as $300 to $400 now. It has gone up every single year. And to complete this form, they charge, we have to call on everyone. So we call the HOA, we tell them what we're sending them, how many questions. They're expecting this now. Most of them have been notified of it. And so they're giving us a price. And I think the last one was like $375. So, and then the seller has to pay a lot more than that to get his part of the condo docs. And if we're doing a full review on a 95% loan, then it's more. And if we're doing a rush, it's more. So that's just the basic charge.
Yeah. $300, $400 for 13 questions.
Yes.
Just throwing that out there. But what about your sellers? If your seller asks, what can I do to ensure my property does not fall out of escrow due to these changes? We kind of talked about this as well. If there's a property you're worried about, getting those first documents in front, and then we can review them and say, you know, maybe try to find a buyer that's all cash or something like that.
Or send us the minutes too.
Yeah.
They have the last 2 minutes of the last 2 meetings. That tells us a lot about any deferred maintenance, because it's usually brought up at the HOA meetings, at the members meetings, board meetings, you know, and they talk about the maintenance that needs to be done and how they're going to finance it and when they're going to start it. Very important things are in the minutes, if you can get the minutes.
Yep. And then, did I receive the HOA minutes? Does your seller receive the HOA minutes? Yes. If your seller's pushing back on this, it's because they got rid of the HOA minutes after receiving it.
Probably
But
threw
they
them
did,
away.
yeah, they do have these documents.
It's a requirement from everybody that they get the minutes, that they get the budget, and then they get the reserve study. So they should have all of those documents if they save them. A lot of sellers don't save them.
And we had a comment about the minutes are from several months ago, though. That's okay, as long as because we're looking at if they talked about deferred maintenance. So whatever they had in their last meeting, if there was deferred maintenance, it was probably brought up. And so that can just be kind of an early flag. If that's all you can get, if you can get all these documents, we have a better understanding. But if that's all you can get up front, it just gives us an idea. So that's basically, we're just trying to get ahead of it in any way that we can. And we're not saying this will be a problem, but we think that it's going to change the industry for the better. We think that's going to make HOAs more accountable of showing these documents, and will be better for our buyers.
If you ever have a buyer that you close an escrow on, 3 months later they were informed about a big special assessment, and they call you and complain to you why you didn't know about it and why you didn't tell them. I mean, this should eliminate that.
Yeah.
So this is really a good thing to happen for the buyers. The buyers should know more about their condo project when they close escrow.
Yep.
And then be able to make a decision with time to think about it.
Perfect. And so then now I'm going to kind of circle back to Ben's question real quick, which he said slightly off topic, but related to lending. What are we experiencing with buyers obtaining insurance? It's difficult out there. We know this. We have a couple of insurance people that we can recommend, but we know that it's very difficult, especially in the market with a lot of insurance companies pulling out.
There are still insurance companies out there. What it's more important than ever is giving them 2 or 3 choices. Like I have a loan that I'm doing right now where they got a quote for the insurance, what I thought was really, really high. And so we gave them a name of 2 other insurance companies, and they were able to get and the quote was for flood insurance. It was a condo in Oceanside that's in a flood zone. And the quote she got was just, my buyers was very, very high. And I thought it was, and I talked to my underwriter, and then we all thought it was high. And so I called the listing agent and asked the listing agent if they'd heard of anybody in the project, in that condo project, and where they were getting their insurance. And he got the name of an insurance company that the insurance was almost less than half of what the first quote was. So it made a huge difference. So yes, it just means being more proactive, getting more quotes, and finding, because there are companies out there that are still reasonable.
And because we see so many different insurance quotes come in, we can, if your buyer is struggling, we can try to help in what we're seeing out there. And maybe some other people we can recommend to get a couple quotes from.
And a lot of times when buyers are getting quotes on their condo insurance, their insurance company gives them a quote for full insurance, like it was a single family house. And whenever we see that, we always say, hey, this quote is really higher than you should be getting. Are you sure you told them you just needed walls in? Go back to them and talk to them again. And they almost always get it corrected. So we're very, very up on top of that. And if we see something that's out of the range, we're always telling them to double check it.
Yeah. But yeah, we have a couple major insurance providers pulling out of the market, which makes just doing due diligence more. And I think that's kind of the whole purpose of this entire presentation.
All of us.
Due diligence.
Right.
Especially with condos now.
So we're going to be, like we said, this form is there for you to look at. You can give it to your buyers. It's fine. Give it to anybody. But it's something that goes into effect at the middle of September. So the middle of September, from then on, whenever any loan closes, any loan that was taken at that time. So if the loan was originated on or after September 15th, this form is required on any Fannie or Freddie loan to be in the package when it's closed.
But we are already seeing it now.
Yes, well, we send it out already.
Yeah.
So we're experimenting with it. We're seeing, and we had no resistance whatsoever, and they did not increase the rate on it because it was so many questions.
Yeah. Sorry, went a little bit over. There was a lot of information in today's presentation, but we think it's all very important. We'll stay on for a little bit longer if anyone has any questions. Oh wait, here we have another. I want to list a condo in a building with foundation issues. Any suggestions?
Yes. Okay, this form that's going to be coming up, they will say that there are. So do you know when they're projecting to fix the foundation? So here's what we would have to do a loan in this project. If we're told on this form that there's a foundation issue and we're going to want to deal with that up front, is we need the structural engineer's report.
It's been going on for the last 2 years.
Have they started any work, or is it just have they just put it off because they didn't have the money?
No, they have not started any work.
Okay. Then if they're telling me it's health and safety, which it probably is going to be, then it's probably a property that would not be eligible for Fannie Mae and Freddie Mac. And, give us a call. We can start exploring it now. We can get a copy of whatever you have, and we can see if it meets their guidelines. So right away if it needs, and then we can also give you the names of portfolio lenders who would do it and how much down they would require. So how to market the property. That's going to be work that you'll want to do up front, and let us help you if you want, and to determine who will lend in it and what the difference is going to be, so it can be marketed that way.
And I definitely think, screening those offers for making sure that none of the lenders who won't accept it are on there. And then also maybe telling buyers, this is happening. It's not Fannie Mae lendable, or it's not FHA lendable, or so on. But we can help you kind of navigate that specific situation. Yeah.
Okay.
Seems there. Mark said maybe asking the seller for their current insurance info would be good. Yeah, back to the insurance, definitely. The current seller, or the seller, knows who their insurance provider is. We are seeing companies like State Farm, for example, who's not writing any new insurance. They're still keeping their current. But as many people as you can ask is the best, because that's just kind of the insurance market that we're in today.
And the other thing we're doing is really day one, when we start a loan, we're telling the buyer to start looking for their insurance. So that's another really important thing, that the buyer knows that they can't wait till the end like they did in the past. They have to start working on that the first day of their escrow.
Perfect. So again, if you have any questions, throw them in the chat, or you can come off mute. If not,
send us an email.
Or if you have them later on, or you wake up in the middle of the night with a question, you can call in, or don't call us in the middle of the night, but text us or email us, or you can even call us. And
then our next meeting will be October
the first Tuesdays, first Tuesday of October. But everyone have a great Labor Day weekend and holiday,
and get those sellers to list and those buyers back getting pre-approved.
Awesome.
All right.
Thank you.
Have a great week. Bye.